Nobody told you the ending. They showed you the headline. Invest early. Start small. Time in the market. They handed you the bumper sticker version of a conversation that should have lasted hours. And then they moved on. And you nodded. And you still didn't do anything. That ends today. In the next 6 hours, we're going to walk through every decade, every scenario, every number, every excuse, every psychological trap, and every specific move you need to make to understand completely what happens to your financial future if you invest just $100 every single month. Hit subscribe if you want to keep running the real math, because this channel exists for exactly this kind of conversation, the one nobody else is willing to finish. Let me set the scene before we start. Somewhere right now, someone just spent $100 on takeout. Saturday night, for people, delivery fees, the tip that felt wrong to skip, done, gone. And somewhere else, right now, someone just set up an automatic investment of $100 a month into an index fund. Same 100. Different decision. Fast forward 30 years. The person who ordered the food, they have memories of good pizza. They genuinely do. And the person who invested, they have around $350,000 sitting in an account from money they barely notice leaving each month. That is not a motivational poster. That is compound interest doing exactly what it was designed to do without asking for your attention, without caring about your mood, without waiting for you to feel ready. Now, here's the question. This entire video is built around the one that lives in the thumbnail. The one I will not fully answer until the last 10 minutes. Is $100 a month actually enough? I want you to sit with that, because the answer is not what you think it is. And by the time we finish, after the math, the mistakes, the real stories of real people, the objections, and the exact steps, you understand it in a way that changes what you do this week, not next year. This week, let's start at the beginning. The actual beginning. Most people never start investing. I do not mean they delay it slightly or they start late. I mean they never begin. They think about it regularly. They research it occasionally. They feel vaguely guilty about not doing it constantly. And they never actually click the button and send money somewhere it can grow. The research on this is not encouraging. A significant portion of working-age adults in developed countries hold little to no market investments despite having discretionary income. And the most commonly cited reason is not lack of money. It is not lack of access. It is the belief that the amount they have is not enough to matter. That belief is the trap. And the trap is beautifully designed, by the way. Nobody engineered it. It emerged from the culture around money. The way wealth is portrayed as something that requires a dramatic starting point. You see the guy on YouTube with the portfolio screenshots? You see the Reddit posts about someone turning 20,000 into 200,000? You absorb, slowly and unconsciously, the idea that investing is something people do once they have serious money to work with. And $100 doesn't feel serious. Here is what nobody told you. The math of compounding does not care about your starting point. It cares about your time horizon and your consistency. $100 invested every month for 40 years at an 8% average return, a conservative figure for a diversified index fund portfolio over long periods, turns into approximately $349,000. You personally contributed $48,000 of that. The rest, $301,000, came from compound interest, from money making money, from returns, earning returns, from the engine that Einstein may or may not have called the eighth wonder of the world, but that every serious investor treats with something close to reverence. The reason that number is hard to believe is that it doesn't feel like it's happening for most of the journey. In year 5, your account might have $7,000. That does not feel like the beginning of $350,000. It feels like a savings account that got a little interesting. And that feeling, that sense of invisible progress, is where most people quit. And quitting at year 5, or year 3, or before year 1 even begins, is the single most expensive financial decision the average person makes without realizing it was a decision at all. We're going to cover this completely. Every decade, every scenario, every number. And before this video ends, I will show you what happens if you start today at your exact age and what that means for you specifically. Before we go further, let me tell you what this video does that no other video on this topic does. Most videos about $100 investing give you the final number. 350,000, they show you the graph. The graph goes up dramatically. You feel motivated for about 4 minutes. Then you close the tab and forget about it, because motivation without a complete, specific framework is just entertainment. This video is not that. We are going through every vehicle, every account type, every fund, every variable. We are running the decade-by-decade simulation in real time so you can see exactly how the number builds. We are addressing every legitimate objection with real data. We are naming every psychological trap that keeps intelligent people from doing obvious things. And at the end, I am giving you exactly 6 steps, not a philosophy, not a mindset shift. 6 specific actions to execute before midnight tonight. Stay until the end, specifically because of part 5. That is where we run the full 40-year simulation, decade by decade, and the number at year 40 will genuinely change the way you think about the money currently sitting in your checking account. Let's talk about the math they never taught you. Your school taught you algebra. It taught you how to find x. It taught you the quadratic formula, which you used twice in your life and never needed again. It did not teach you compound interest. It did not teach you the rule of 72. It did not teach you that the most powerful financial force in a regular person's life is not their salary. It is the length of time their money has to grow. That is not an accident, by the way. Financial literacy has historically been the province of people who were already wealthy. The grammar of money was never delivered to the people who needed it most. Let me fix that now. Compound interest is interest on interest. That's it. That's the entire concept. When you invest $100 and it earns 8%, you end year 1 with $108. The next year, that 8% applies to 108, not just the original 100. The interest you earned last year now earns interest this year. And next year, that slightly larger number earns interest, and so on and so on. For decades. The longer this runs, the more violent the growth becomes. Not violent in a frightening way. Violent in the way of a mathematical fact that feels impossible until you see it happen. Now, let me give you a tool. The rule of 72. This is one of the most useful mental shortcuts in personal finance, and most people have never heard of it. To find out how many years it takes your money to double, you divide 72 by your annual return rate. At 6%, your money doubles roughly every 12 years. At 8%, every 9 years. At 10%, every 7 years. At 12%, every 6 years. Write that down, because it means that at an 8% return, $1,000 becomes $2,000 in 9 years, $4,000 in 18 years, $8,000 in 27 years, $16,000 in 36 years, from one investment. Without you touching it, the doubling accelerates over time, which is the core insight of compound interest that most people intellectually understand and emotionally fail to apply. Now let's run the numbers at different return rates, because the rate matters enormously over long periods. If you invest $100 every month for 30 years at 6% annual return, which is a conservative estimate, you end up with approximately $100,000. You personally invested $36,000 at 8%. The same 30 years produces roughly $140,000 from the same $36,000 of your money. At 10%, you are looking at approximately $227,000 at 12%, which requires more risk and is harder to sustain consistently. You're approaching $350,000 over 30 years. The difference between 6% and 10% over 30 years is more than double the final outcome from the same monthly contribution. This is why the account you choose and the assets inside that account matter enormously, which we will cover completely in part 3. But first, let me show you the single most important variable in this entire equation, and it is not the return rate. It is time. The late startup penalty is one of the most brutal, irreversible facts in personal finance. And I'll use the word brutal deliberately, not to shame anyone, but because the mathematics demands honesty. Consider this comparison. Someone starts investing $100 a month at age 20. They invest for 40 years until 60. At 8% return, they accumulate approximately $349,000. Someone else starts At 30, same amount, same return rate, 30 years instead of 40. They accumulate approximately $149,000. The 10-year head start produced $200,000 of additional wealth. The person who started at 20 did not earn more. They did not invest more each month. They simply started earlier. Time, not contribution amount, is the governing variable of compounding wealth. Now, let's extend this to age 40 and 50, because if you are watching this and you are 40 or 50, I need you to hear this clearly. Starting at 40, investing $100 a month for 25 years at 8% produces roughly approximately $95,000. Starting at 50, 20 years gives you approximately $59,000. Those numbers are smaller than the 40-year number, but they are not zero, and they are not nothing. They are the difference between having meaningful financial cushion at retirement and having none. The best time to start was 20 years ago. The second best time is right now. That is not a cliche. It is a mathematical statement about the only variable in this equation that you can still control. Let me show you one more table before we move to accounts. The total invested versus total earned breakdown is the moment in this video where most viewers stop and rewatch the number. Over 40 years of investing $100 a month at 8%. You personally put in $48,000. Your ending balance is approximately $349,000. The interest, the compound growth, contributed $301,000. You put in 14% of the final balance. The market contributed 86%. This is not a trick. This is not an exception. This is exactly how compounding works when given enough time. Your contributions matter enormously in the early years. They matter as the seed. But the tree grows without you. The tree produces fruit, returns that grow more fruit, reinvested returns that grow even more fruit. For decades, while you go to work and live your life and occasionally feel vague anxiety about money, your invested $100 a month is compounding silently in the background, doing math you do not have to watch. And most people never let it start because they are waiting for what they could not tell you. Waiting for a better time. Waiting to understand it more completely. Waiting to have more to invest. The waiting is the loss. Every month of waiting has a specific, calculable cost in future purchasing power, and we will name those costs exactly in every section of this video. Most people also miscalculate because they forget reinvest. They mentally model their investments as a savings account. Money goes in, sits there, earns a flat rate, comes out later. That is not how compounding works. Every return you earn is reinvested and begins earning its own return. This is the mechanism. This is why the math gets increasingly violent over time. If you withdraw your gains annually, if you take the dividends as cash, if you cash out and re-enter, if you hold things in taxable accounts and pay taxes on gains before reinvesting, you are breaking the compounding chain. Every interruption costs you future growth, not present income. The money you take out today is not just that money. It is that money plus everything it would have generated for the next 30 years. In the next section, we are going to cover exactly where to put this $100 because the account you choose changes everything. And I mean that in the most literal possible way. The difference between the right and wrong account for your situation can cost you or save you tens of thousands of dollars in taxes alone over a 40-year investing window. Most people invest in the right things but the wrong account, and they lose thousands to taxes they never needed to pay. Let me walk you through every account type, what it is, what it does, and where $100 a month belongs right now. First, the savings account. I want to address this directly and without sympathy, because the savings account is doing something to your money that nobody explains clearly. Your savings account is almost certainly earning somewhere between 1 and 5% in a high-yield version, and close to zero in a standard bank account. Inflation, the rate at which prices rise over time, has historically averaged around 3% annually in the United States, with significant variance. In recent years, it has been considerably higher. This means that money sitting in a standard savings account is not just failing to grow, it is losing purchasing power every single year. The dollars are still there. They will buy less. The number is the same. The value is smaller. A savings account is a valid place for an emergency fund. 3 to 6 months of expenses kept liquid for genuine emergencies. It is not an investment vehicle. It is not a substitute for investing. And if your financial plan involves a savings account as the primary destination for money you won't spend immediately, you are losing a compounding race you do not know you are running. Now, index funds. This is where $100 a month belongs for most people watching this video. An index fund is a fund that tracks a market index, most commonly the S&P, which is a basket of the 500 largest publicly traded companies in the United States. When you invest in an S&P 500 index fund, you own a tiny piece of 500 companies simultaneously: Apple, Microsoft, Amazon, Google, Johnson & Johnson, all of them. Proportionally, you are not picking a winner. You are investing in the idea that the American economy or the global economy, depending on the index, will be larger in 30 years than it is today. Historically, that has been true. The S&P 500 has returned an average of approximately 10% annually over the past 90-plus years, including crashes, recessions, depressions, wars, pandemics, and every other form of financial catastrophe that temporarily interrupted but never permanently stopped the long-term upward trajectory of market value. Warren Buffett, arguably the most successful investor in modern history, has explicitly stated for the record that when he dies, his instructions for the money left to his wife are to put 90% of it into a low-cost S&P 500 index fund. Not a managed fund, not a hedge fund, not something clever, a simple, boring, low-cost index fund. When the most successful investor in history tells his family to use the same tool available to every regular person watching this video, that is worth pausing on. Now, ETFs versus mutual funds. Many people get confused here, and the confusion causes paralysis. So let me resolve it in 60 seconds. Both ETFs and mutual funds can track the same index. A mutual fund is purchased at the end of the trading day at the day's closing price. An ETF trades throughout the day like a stock. You can buy it at any moment. The market is open. For someone investing $100 a month on a regular schedule, this distinction is almost completely irrelevant. Both hold the same assets. Both compound in the same way. The practical differences for a beginning investor are minimal. Where they differ meaningfully is in fees expense. Many index ETFs carry expense ratios of less than 0.1% annually. Many actively managed mutual funds charge 1 to 2% annually. That difference in fees, compounded over 30 years, represents a difference of tens of thousands of dollars in your final balance. We will come back to the fee trap in exact dollar terms in Part 6. For now, remember, low-cost index ETF or index mutual fund. Both work. Pick one with an expense ratio below 0.2% and move on. Now, the Roth IRA, if you are a young person in the United States and you do not have a Roth IRA, this is the most important sentence of the entire video. Open one today. The Roth IRA is a retirement account that lets you invest money you have already paid taxes on and then grow that money completely tax-free for the rest of your life. You pay no taxes on the gains. You pay no taxes on qualified withdrawals in retirement. The money compounds without the government taking a share on the way out. For someone who is 25 and in a low tax bracket today but expects to earn more in the future, this account is structurally one of the most powerful financial tools available to regular people. The contribution limit in 2024 is $7,000 annually, or roughly $583 a month. $100 a month fits comfortably inside this limit with room to grow. The income limits to contribute to a Roth IRA phase out at higher income levels. At the time of writing, the phase out begins around $150,000 for single filers, so check your eligibility. But for most people watching this video, the Roth IRA is available, underused, and enormously powerful. The 401k. If your employer offers a 401k with a match, even a partial match, and you are not contributing enough to capture the full match, you're leaving free money on the table. Full stop. An employer match is an immediate 100% return on the matched portion of your contribution. Nothing in the investment world offers that. A 50% match on your contributions up to 6% of your salary. A common employer structure means your $100 a month contribution instantly becomes $150 per month, sometimes $200, before it even reaches the market. Capture the full employer match first. Before the Roth IRA, before anything else, the match is the highest returning investment available to you mathematically by a wide margin. Brokerage accounts. A taxable brokerage account, a standard investment account not attached to any retirement structure, offers complete flexibility. You can withdraw any time, invest any amount, hold virtually any asset. The trade-off is taxes. Your gains are subject to capital gains tax when realized. Long-term capital gains on assets held longer than a year are taxed at preferential rates. But the tax drag is still real. For most people early in their investing journey, the Roth IRA and 401k should be maximized before opening a taxable brokerage. But if you have maxed those out, congratulations. You are doing extremely well. The brokerage account is the next stop for international viewers. The structural logic of every account type 1 just described applies globally, even if the specific name differs. In the United Kingdom, the ISA individual savings account is the closest equivalent to the Roth IRA. Gains and withdrawals from stocks and shares, ISA, are tax-free. The annual contribution limit is £20,000. In Canada, the TFSA tax-free savings account works similarly. Contributions are made with after-tax money, and growth plus withdrawals are completely tax-free. In Australia, superannuation is the primary long-term investment vehicle, with employer contributions mandated by law and favorable tax treatment on investment returns inside the fund. In India, the ELSS equity-linked savings scheme offers tax deductions on contributions and exposure to equity markets. Every country has some version of a tax-advantaged investment structure. Find yours, use it. The specific name differs. The logic is identical. Reduce the tax drag on compounding wealth over long periods. Which account wins for someone starting today? If your employer offers a 401k with a match, contribute enough to capture the full match first. Then open a Roth IRA and fill it with your remaining monthly investment. If your income exceeds Roth IRA eligibility limits, use a traditional IRA or go back to the 401k. If you have maximized both, open a taxable brokerage. This is the order. This is the framework. It is not universal. There are edge cases and individual circumstances that a fee-only fiduciary financial advisor can address, but for the overwhelming majority of people watching this video, this sequence captures the maximum tax advantage available to you at every contribution level. Coming up next, I will tell you exactly what to invest in, including the single fund that Warren Buffett told his own family to buy. You have the account, you have the $100. The question now is, what do you actually click? Let me walk you through this exactly. Index fund investing, step by step. You open the account, we covered which one. You transfer money, $100, or whatever you are starting with. You search for a fund, you click buy. That is the entire process. The psychological complexity around, I need to understand this better before I start, is one of the most expensive cognitive traps in personal finance. And I say that, having experienced it personally, I spent months reading about investing before I invested a single dollar. In those months, the market went up. I missed those gains because I was busy learning about them instead of capturing them. The S&P 500. This is the index that matters most for most people starting from zero. The S&P 500 is a collection of the 500 largest publicly traded companies in the United States, weighted by market capitalization. It is not an investment itself. It is a measuring stick. What you invest in is a fund that tracks that measuring stick. When the 500 companies in the index collectively grow in value, your fund grows. When they collectively fall, your fund falls. Over long periods, they have collectively grown dramatically. Since 1926, the S&P 500 has produced an average annual return of approximately 10%, including all the crashes, including 1929, including 2000, including 2008, including March 2020, when the entire market fell 34% in 33 days before recovering 2 new highs within months. The long-term average includes all of that. Every catastrophe, every panic, every prediction of permanent collapse. The index recovered, it always has. Past performance does not guarantee future results. That is a legal disclaimer and also a genuine truth, but the structural argument for broad market index investing over long periods is among the most well-supported ideas in modern finance. Now, 3 specific funds worth knowing. VU, VTI, and FXAIX. VU is Vanguard's S&P 500 ETF. It tracks the S&P 500 expense ratio of approximately 0.03% annually. Nearly free. VTI is Vanguard's total stock market. ETF, it tracks not just the S&P 500, but essentially the entire U.S. stock market, including small and mid-cap companies, slightly broader exposure. Same ultra-low expense ratio. FXAIX is Fidelity's equivalent of S&P 500 Index Mutual Fund, available inside Fidelity accounts. No minimum investment, expense ratio of 0.015%. If you use Fidelity, this is the one fund answer for most people. If you use Vanguard, it is View or VTI. If you use Schwab, their equivalent is SCHB or SW. Should you add international exposure? The honest answer is, it depends on your time horizon and your conviction. International index funds, which track stocks in developed markets outside the U.S. or emerging markets, provide diversification against the scenario where the U.S. economy underperforms relative to global markets over your investment window. Some investors hold a 10 to 20% allocation in international funds. Others are entirely used. There is no consensus among serious financial researchers on the optimal allocation, and the historical U.S. outperformance over recent decades has been extraordinary, but past outperformance is not guaranteed to continue. For simplicity at the start of your journey, 100% in a total U.S. market fund is a defensible, research-supported, reasonable starting point. You can add international exposure as your portfolio grows and your understanding deepens. Bonds. Do you need them when starting small? Generally, at younger ages, the argument for holding bonds in your portfolio is weak. Bonds, government, or corporate debt instruments that pay fixed interest are lower risk and lower return than stocks. For a 30-year-old investing $100 a month with a 40-year runway, bonds significantly dampen the compounding potential of the portfolio without providing meaningful protection against the risk. That time itself mitigates. Market crashes at 30 are not the same threat as market crashes at 6. At 30, a crash is a sale. Your monthly contributions buy more shares at lower prices. At 65, a crash is a danger. Your withdrawals sell shares at depressed values. The classic rule of thumb, hold your age in bonds. So 60% stocks and 40% bonds at age 60 has been debated and modified extensively by modern research. At the start of your investing journey, if you have decades ahead of you, a simple equity index fund requires no bonds to be a defensible strategy. Dollar cost averaging. This concept is worth understanding deeply because it changes how you feel about market volatility. Dollar cost averaging means investing a fixed amount at regular intervals, say $100 every month, regardless of what the market is doing. When markets are high, your $100 buys fewer shares. When markets are low, your $100 buys more shares. Over time, this averages out your cost per share in a way that tends to be more favorable than trying to time the market by investing large sums only when you think prices are right. Research from multiple sources suggests that for regular investors without large lump sums to deploy, dollar cost averaging produces outcomes that are difficult to beat. And more importantly, it removes the psychological burden of timing decisions. You do not have to decide when to invest. You have already decided every month, automatically. The market can do whatever it wants. Your $100 goes in regardless. What to do during a market crash. This section alone could save you more money than any other part of this video. When the market crashes, and it will, multiple times over a 40-year investing window, every instinct you have will tell you to do something, to sell, to move to cash, to wait until things stabilize. Every one of those instincts, acted upon, is enormously costly. Here's the counterintuitive truth. A market crash is the best thing that can happen to a young investor who is consistently investing fixed monthly amounts. When the market falls 30%, your $100 this month buys 30% more shares than it did last month. You are accumulating ownership at a discount. When the market recovers, and historically, it has always recovered, those discounted shares recover in value, and you own more of them than you would have if the market had never crashed. The investors who panicked and sold during 2008 locked in their losses. The investors who held, or better, continued contributing through the 2008 crash, recovered fully and then some. The same pattern played out in 2020 and in every previous crash in market history. The one rule to internalize. Now, before you begin, market crashes are not emergencies. They are sales. Your job during a crash is to keep contributing and to resist the urge to check your portfolio balance. The one fund portfolio, for people who want to set it and forget it. Choose one total market index fund, VTI SCHB, or the equivalent in your account. Set up automatic monthly contributions of whatever amount you can sustain. Turn on dividend reinvestment. Walk away. Check once a year, at most, to confirm everything is running. That is the entire portfolio. One fund, one decision, automatic, execution. This is not the most sophisticated investment strategy available. It is one of the most effective for regular people with full-time lives and no desire to manage a portfolio actively. The research on this is consistent. Most actively managed funds, managed by professional investors with full-time research teams, underperform their benchmark index over 10-year periods. The simplest possible strategy on the market beats the majority of strategies that are considerably more complex. After the next section, we run the full 40-year simulation. I will show you the exact decade-by-decade growth. The number at year 40 will genuinely surprise you. Let's actually watch your $100 a month grow in real time. I want to walk you through this decade by decade, starting from zero, so you can see exactly how the compounding engine behaves at every stage of the journey. Because understanding that the final number is $349,000 is very different from understanding how it gets there. The path matters psychologically as much as the destination. We are using 8% annual return as our benchmark. This is a conservative to moderate estimate for a diversified U.S. equity index fund over long periods, adjusted downward from the historical 10% average to account for fees, variance, and the fact that future returns may differ from historical ones. When I show you the numbers at 10%, treat those as the optimistic scenario. At 8%, treat these as the baseline. Years 1 through 5, the frustrating phase. At the end of month 1, you have $101. The math is not impressive. At the end of year 1, you have contributed $1,200. With compounding at 8%, your balance is approximately $1,250. A $50 gain. If that is the first thing you see in your investment account, you may feel like this is not working. This feeling is normal. It is also the primary reason most people quit. The first year of compounding is the weakest year of compounding by design. The engine is just starting. By the end of year 3, you have contributed $3,600 and your balance is approximately $3,900. The growth is still small, a few $100s, but it is becoming visible. By the end of year 5, you have contributed $6,000 and your balance is approximately $7,300. The compound interest has added over $1,300 to your contributions. You can see it now. It's small, but it's real. And this is the moment where something important is happening and visibly the foundation of everything is being laid. Every dollar you have right now will compound for the next 35 years. The critical psychological rule for years 1 through 5. Do not stop. The people who stop here will never see what happens next. And what happens next is the reason this investment exists. Years 6 through 10. The first sign of life. By year 7, something starts to feel different. Your monthly contribution of $100 is now being joined by a growing pool of existing capital. And that pool is earning returns that are starting to approach and then exceed your monthly contribution. By the end of year 10, you have contributed $12,000. Your balance is approximately $18,000. The market has added $6,000 to your contributions. Your money has grown by 50% beyond what you put in. This is meaningful now. $6,000 of growth from $12,000 of your money is a 33% bonus on top of what you contributed, generated by time and compounding rather than any additional effort on your part. And something else is happening at year 10. Your $80,000 is now generating approximately $120 per month in compound growth, more than your actual monthly contribution. For the first time, your money is doing more work than you are. Every month, the market contributes more to your balance than you do. This is what financial independence actually means at its root, not a specific dollar amount, but the moment when capital begins working harder than you do. What could this $18,000 do for you right now, even without withdrawing it? It is a financial cushion that changes your relationship with risk. It is the basis for a down payment. It is leverage for opportunity, and it is the foundation that the next 20 years will build upon in ways that seem impossible from where you are standing today. Years 11 through 20, the momentum phase. This is the decade where the snowball starts rolling on its own with real weight. By year 15, your balance is approaching $35,000. By year 17, you are over $40,000. By year 20, you have contributed $24,000 and your balance is approximately $58,000. The market has contributed $34,000 more than your total contributions to your balance. Here is the number inside that number that matters. Achi, yeah. 20. Your $58,000 generates approximately $387 per month in compound growth at 8%. You are contributing $100. The market is contributing $387. The ratio has flipped decisively. You are now, in a very real sense, a passive recipient of wealth being generated by time and prior investment rather than by current effort. Your 20 years of consistent contribution has created a machine that runs without you. This is the phase where the most painful what-if calculations live. The person who quit at year 5, who had $7,000 and decided it wasn't growing fast enough, missed $51,000 of compound growth by year 20. The person who started at 20 and is now 40 is $58,000 from $100 a month. The person who said they would start at 30 at the same age is just beginning. The gap is not in effort. The gap is purely in time. Years 21 through 30, the accelerate. The third decade does more wealth-building work than the first two combined. If that sentence sounds impossible, the math will make it feel inevitable. At year 25, your balance is approximately $95,000. You have contributed $30,000 total. The market has added $65,000. You're approaching a threshold that most people spend their entire careers dreaming about. $100,000 in investable assets. By year 30, you have contributed $36,000 of your own money. Your balance is approximately $149,000. The market has generated $113,000 in compound growth, more than 3 times your total contributions over 30 years. $113,000 from $100 a month, consistently invested, untouched. What changes in your life when you cross the $100,000 mark? Not as much as you might expect on the surface. Your lifestyle does not automatically transform, but your relationship with financial risk changes fundamentally. $100,000 in a long-term investment account is not just a number. It is years of financial runway. It is the foundation for the next phase of compounding that makes the numbers genuinely difficult to believe. It is the reason the first 30 years of consistent investing feels like preparation, and the last 10 feel like payoff. Years 31 through 40. The explosion. This is the decade that justifies everything. This is the decade that makes the frustrating first 5 years, the slow middle years, the quietly accelerating middle phase. This is the decade that makes all of it make complete sense. By year 35, your balance is approximately $214,000. By year 38, you are approaching $300,000. By year 40, from $100 a month at 8%. For 40 years, your balance is approximately $349,000. You personally contributed $48,000. The market contributed $301,000. Let me write that again, more slowly. You put in $48,000. The compounding engine produced $301,000. You are responsible for 14 cents of every dollar in that account. The market time, compounding, reinvestment is responsible for the other 86 cents. At 10% annual return, which the S&P 500 has historically produced before inflation, the same 40 years of $100 per month produces approximately $632,000 from $48,000 of your money. That number feels wrong when you first read it, but it is the arithmetic of compounding applied to time, and it is available to anyone willing to start and stay consistent. Now, the gap between what you invested and what you earned, this is the moment in this video where I need you to stop and sit with the math for a second. Most people who want to get wealthy think about increasing their income. And income matters, but income is a flow. Compounding is a multiplier. Someone who earns $50,000 a year and invests consistently for 40 years will end up with far more than someone who earns $200,000 a year and invests nothing, because income without time in the market produces nothing beyond what can be spent. The person earning $200,000 and spending it all has a zero-sum financial life. The person earning $50,000 and investing $100 a month for 40 years has an engine that eventually generates more per month passively than some people earn actively. That is not a motivational statement. It is the compounding math applied honestly. Now, let's talk about the variables, because what if you could turbocharge this without earning more money? You probably can. The first variable. What if you increase your monthly contribution by just $25 every year? Year 1, you invest $100. Year 2, 125, year 3, 150, and so on. This does not require a raise. It requires a kind of spending audit that most people avoid because they're afraid of what they will find and what they will find. Almost universally is a handful of subscriptions they forgot they had, a food delivery habit that is quietly expensive, a gym membership funding someone else's business because they have not walked through the door in 8 months. $25 a month of redirected spending, not sacrifice, just redirection produces dramatically different outcomes over 40 years. The difference between $100 a month flat for 40 years and $100 per month growing by $25 annually is not a small gap. It is potentially hundreds of thousands of dollars at the end of the runway, because the larger contributions in the later years coincide with the most powerful phase of compounding. The second variable, lump sum additions. If you receive a tax refund, the average U.S. tax refund is somewhere around $3,000, and you invest even half of it annually into your index fund. You are accelerating the timeline of compounding significantly. A $3,000 lump sum addition at year 5 on top of your regular contributions adds substantially to the base that the next 35 years will compound. Windfalls are often the most misused financial resource in a regular person's life. Spent, they purchase things that depreciate immediately. Invested, they purchase compounding time. The third variable, dividend reinvestment. Most broad market index funds generate dividends, distributions from the profits of the underlying companies in a standard account. These dividends can be paid to you as cash or automatically reinvested to purchase additional shares. Reinvesting dividends is the compounding engine's fuel. When you take dividends as cash, you interrupt the compounding cycle. When you reinvest, every dividend buys shares that generate future dividends that buy more shares. Over 40 years, dividend reinvestment can add tens of thousands of dollars to your final balance compared to the same investment with dividends paid out and spent. Turn dividend reinvestment on when you set up your account. Then forget it exists. The fourth variable, inflation. $349,000 in 40 years will not purchase what $349,000 purchases today. Inflation erodes purchasing power over time, historically at a rate of roughly 2 to 3% annually in developed economies. At 3% average inflation over 40 years, $349,000 in future dollars is worth approximately $107,000 in today's purchasing power. That is still more than double what you personally invested. That is still meaningful wealth by any measure. But it is an important reality to name because videos that quote the gross dollar figure without mentioning inflation are doing you a disservice. The real return on your investment, adjusted for inflation, is lower than the nominal return. And it is still dramatically positive. Inflation reduces the headline number without eliminating the fundamental case for investing. The alternative, keeping your money in cash, loses purchasing power to inflation with certainty and earns nothing in return. The fifth variable, fees. And this is where I need you to pay close attention, because the fee trap is one of the most insidious and least discussed wealth destroyers in personal finance. A financial advisor who charges 1% annually on your assets, a common fee structure, costs you dramatically more than 1% of your returns. Because the 1% they charge does not just cost you that 1% in the year it is charged. It costs you every dollar that 1% would have compounded into over the remaining years of your investment window. A 1% annual fee on a portfolio growing at 8% does not cost 1/8 of your returns. It costs more than that because the fee reduces your compounding base every year. The math on this is specific and it is devastating. Over a 40-year period, a 1% annual advisory fee on a portfolio built on a $100 monthly investment at 8% costs you approximately $100,000 in foregone compounding. $100,000, not because the advisor stole anything, not because they did anything wrong. Simply because every dollar they take this year is a dollar that would have compounded into multiple dollars over the remaining decades. A passive index fund with an expense ratio of 0.03% costs you almost nothing by comparison. The difference in terminal portfolio value between the two strategies at the same underlying return is not a rounding error. It is the cost of a comfortable year of retirement or more. The sixth variable, taxes on gains, and how account choice eliminates most of this problem. In a taxable brokerage account, capital gains are taxed when realized Short-term gains from assets held less than a year are taxed at your ordinary income rate. Long-term gains are taxed at preferential rates, typically 0, 15, or 20% depending on your income. This tax drag, compounded over 40 years, can reduce your final balance by tens of thousands of dollars compared to investing the same amounts in tax-advantaged accounts. This is why the account hierarchy matters so much. In a Roth IRA, hinaugudayorges grow completely tax-free. In a 401k, your contributions reduce your current taxable income, deferring the tax hit to retirement when your income and FXAIX may be lower. The difference between a taxable and tax-advantaged account, all else equal, is free money in the form of taxes you never pay. The seventh variable, sequence of returns risk. Here is a concept that most investment explainers skip, and it can matter enormously to investors who are near or at retirement. Sequence of returns. Risk is the danger of experiencing a major market downturn early in your withdrawal phase, when you are taking money out rather than putting money in. A 40% market crash in your first year of retirement, when you are withdrawing to live on, is catastrophically worse than the same crash in your first year investing when your monthly contributions are buying discounted shares. For a young investor decades from retirement, sequence of returns risk is a distant future consideration. For someone approaching retirement within 10 years of drawing down the portfolio, it becomes the central risk to manage. This is one of the primary reasons that some shift from 100% equity toward a mixed portfolio as retirement approaches. Not because stocks are bad, because the timing of losses matters when you are selling rather than buying. This is why we talk about where you are in the journey, not just whether you should invest. Now, let's talk about real people, because everything I have shown you so far is math, and math does not have a face. Ronald Reed was a janitor. He worked at a JCPenney for many years. He drove a second-hand car. He ate modestly. He wore a safety pin to hold his coat together because he did not want to spend money on a new button. When he died in 2014 at the age of 92, his estate was worth approximately $8 million. He left most of it to a local library and hospital. Ronald Reed did not inherit wealth. He was not a tech founder. He did not work in finance. He was a janitor who invested consistently in dividend-paying stocks over decades and never sold. He never earned a high salary. He never made a dramatic financial move. He simply invested consistently in things he understood and let time do the work. His story became famous after his death precisely because it felt impossible. A janitor with $8 million. How? The answer is the same answer. This entire video has been building toward time, consistency, and the refusal to interrupt compounding. Now, let's run a case study on a 25-year-old teacher named Maya. Maya is 25. She earns $42,000 a year as a public school teacher. After taxes, rent, student loan payments, and basic living expenses, she has about $200 of discretionary money each month. She decides to invest half of it, $100 per month. She opens a Roth IRA. She puts it into VTI, the total stock market index fund. She sets up automatic monthly contributions. She turns on dividend reinvestment. She does not touch it. At age 35, Maya's account has approximately $18,000 in it. She has contributed $12,000. The market added $6,000. She is not rich, but she has more invested than the majority of Americans her age. She has been doing this for 10 years. She keeps going. At age 45, Maya has approximately $58,000. She has contributed $24,000. The market has added $34,000. She is now earning more in monthly compound growth, around $380, than she contributes monthly. The machine is running. At age 65, Maya has been investing for 40 years. Her balance is approximately $349,000. She contributed $48,000. She earned $301,000 from compounding on a teacher's salary. From $100 a month, without a side hustle, without a windfall, without a dramatic financial strategy. Maya is not exceptional. She is someone who started, stayed consistent, and let time do what time does. Now, let's talk about the 40-year-old who thinks it is too late. This is the case study I want to spend the most time on because it's too late for me is the most paralyzing and the most false belief in personal finance. Let me destroy it with specifics. If you are 40 years old and you start investing $100 a month today, at 8%, you will have approximately $65,000 by age 65. You will have contributed $30,000 of your own money. The market will have added $35,000. That is not $349,000, and it should not be presented as equivalent, but $65,000 is the difference between financial cushion and financial panic at 65. $65,000 supplements Social Security or a pension. $65,000 is a decade of financial breathing room. $65,000 is not zero. And here's what the 40-year-old forgets. The math does not stop at 6. If they do not need the money at 65, they can continue to invest and grow. If they reduce withdrawals or invest part-time beyond 65, the compounding continues. And critically, even if they cannot maintain $100 a month at 40, they can likely increase that amount significantly in their 50s as other obligations reduce. The early career investor has time as their advantage. The mid-career investor has income as their advantage. These are different edges. Both Hari Heao. The message for the 40-year-old is not you're fine. No rush. The message is start today. Increase the contribution as soon as your income allows. And recognize that the math of the next 25 years still produces something meaningful. Even if it is not the number you would have had if you had started at 20. The college student starting at $50 a month. Let's name them, Jordan. 19 years old. Part-time work. Limited income. They can do $50 a month. Not $100. That is okay. $50 a month at 8% for 46 years from 19 to 65 produces approximately $237,000 from total contributions of $27,600, starting at $50 a month. At 19, from a part-time job. The math is extraordinary when time is the primary input, and Jordan can increase that contribution every year as income grows $25 more per year. As we discussed, transforming the final number dramatically. What common mistakes do real investors make? The first, they watch their portfolio daily. Daily watching leads to emotional reaction, which leads to bad decisions. Check quarterly at most. Monthly, if you genuinely cannot help yourself. Never daily. The second, they chase performance. Last year's best performing fund is consistently not next year's best performing fund. The research on this is extensive, and the conclusion is consistent. Chasing performance is a way of perpetually buying high and selling low, the exact opposite of what compounding requires. The third, they hold too much cash inside their investment accounts. Many people open a brokerage account, transfer money, and then leave it sitting in the account's cash sweep fund earning near interest instead of buying the actual fund they intended to buy. Your money in the account is not invested until you execute a purchase. Check that. Your contributions are actually buying shares. The fourth, they confuse account type with investment type. A Roth IRA is not an investment. It is a container. What lives inside the container, what assets you actually purchase, determines your return. Opening a Roth IRA and leaving it in cash is not investing. Opening a Roth IRA and purchasing an S&P 500 index fund inside it, that is investing. The fifth, they invest without emergency savings. An emergency fund, 3 to 6 months of expenses in a high savings account should exist before or alongside your investment contributions. Without emergency savings, any financial crisis, a job loss, a medical bill, a car repair forces you to withdraw from your investments, potentially at a loss and certainly at the interruption of your compounding timeline. The emergency fund is not a competing priority. It is the foundation that protects your ability to invest without interruption. Now the objections, you have one. I have heard it. Let me address it directly. I don't have $100 to spare. Let me offer you a challenge before we accept this as true. Pull up your last 3 months of bank statements. Look at every transaction, not to judge yourself, to audit the actual data. Most people who say they have nothing left at the end of the month have not done this exercise with honesty. What you are likely to find: a streaming subscription or 3 that have been running since 2021. Food delivery spending that is dramatically higher than you expect when you add it up monthly. Subscriptions to services you signed up for during a free trial and never canceled. A gym membership attached to a gym you stopped attending. Coffee spending that, calculated monthly, is more than $100. None of these are shameful. All of them are The goal is not to eliminate pleasure from your life. The goal is to run an honest audit and make a conscious decision about where that $100 goes. Not the unconscious decision, which is for it to disappear into the friction of daily spending. If you audit genuinely, and there is truly nothing, no discretionary spending to redirect, then start with 50, start with 25. Start with what you can. The compounding logic applies at any contribution level. Time is the variable that matters most. Start with whatever number does not require a miracle. The market is going to crash. Yes, it will. At some point. Probably multiple times over your 40-year window. You will not know when. I will not know when. Nobody will know when. Not reliably. Not actionably. And here is what market crashes mean for a long-term investor who is still in the accumulation phase. Your monthly contributions buy more shares at lower prices. A market crash when you are 30 years old and investing monthly is mathematically one of the best things that can happen to your long-term wealth. Every share you buy during a crash is a share that recovers in value when the market recovers, and the market has always recovered historically. Within a medium-term window, the investors who panicked out of the market in March 2020 locked in losses. The investors who kept buying in March 2020 bought shares at prices they will never see again, and those shares approximately doubled within 2 years. Market crashes are not threats to a young, consistent investor. They are opportunities that feel terrible. I will start when I make more money. This is the most common and most costly version of the starting delay. The research on this is consistent. People generally do not invest when they make more money. They spend more. Lifestyle inflation, the tendency to expand spending to match income increases, consumes most raises, bonuses, and salary jumps before they can be redirected into investment. The person who says, "I'll start investing when I earn more," almost always becomes the person who earns more and still finds a reason to wait. The time costs of this delay is not theoretical. Every 5 years, a delayed starting costs an enormous fraction of the final balance. At 8%, starting 5 years later than you planned reduces your 40-year balance by a factor that is difficult to look at directly. The right time to invest is when you have any money to invest, not when it feels comfortable. Comfort is not the metric. The math is the metric. It's too complicated. The 3-click investing setup for a complete beginner. 1. Open a Roth IRA at Fidelity, Vanguard, or Charles Schwab. 2. Transfer $100 from your bank account into the Roth IRA. 3. Search for FXAIX inside Fidelity or VTI inside Vanguard or Schwab and click buy. Set up automatic monthly contributions. Turn on dividend reinvestment. You are done. You have built the entire framework in 3 clicks and 1 automatic transfer setup. The complexity around investing is real at the advanced level. It is invented at the entry level. You do not need to understand options, bonds, international exposure, tax loss harvesting, or rebalancing strategies to begin. You need 1 account, 1 fund, and 1 automatic transfer. Everything else comes later when it matters. I have debt. Should I invest or pay it off first? The honest answer, which most financial content avoids giving, is it depends on the interest rate. High interest, debt, credit cards. Typically charging 18 to 28% should be paid off before investing in the market because no investment reliably returns 25% annually. Paying off 25% interest debt is a guaranteed 25% return on your money. Medium interests, debt, personal loans in the 8 to 15% range represents a genuine judgment call. The S&P 500 has historically returned 10% on average, which means medium rate debt is approximately neutral relative to investing. Many financial planners suggest to split pay down medium rate debt aggressively while simultaneously beginning to invest small amounts to establish a habit and capture any employer match. Low interest debt, mortgage is typically in the 3 to 7% range, does not necessarily need to be prioritized over investing because the historical market return exceeds most mortgage rates over long periods. The rule: eliminate all high-interest consumer debt before investing significantly. Capture your full employer 401k match, regardless of debt. Then apply surplus to medium-rate debt and investments in proportions that feel sustainable. I don't trust the stock market. I understand this feeling, and I want to distinguish between two very different things: distrust based on fear and distrust based on evidence. If your distrust is based on fear, the feeling that the market is unpredictable and scary, the data on long-term market history addresses that directly. The S&P 500 has never had a 20-year period of negative returns. Never in market history that stretches back to the late 19th century. If your investment window is 20 years or longer, the historical data suggests you have never lost money by holding a broad market index fund. If your distrust is based on evidence, specific, grounded concerns about a particular investment or vehicle, then that is a conversation worth having in detail. But distrust of the market as a general concept, applied to broad index funds over long-time horizons, is not supported by the historical evidence. It is supported by the fact that short-term volatility feels like a threat, and humans are wired to avoid things that feel like threats, even when the long-term data suggests they are not. I'm not American. Does any of this apply to me? Almost all of it does. The compounding math is universal. The behavioral psychology is universal. The specific account types I mentioned, Roth IRA, 401k, are used specific structures. But every developed country has equivalent tax-advantaged investment accounts. The ESA in the United Kingdom, the TFSA in Canada, the superannuation system in Australia, the ELSS in India. The account wrapper is local. The logic is global. Index funds tracking local or global markets are available in virtually every developed financial system. The investment principles: low cost, diversified, long-term, consistent apply regardless of your country of residence. Find your local equivalent of the Roth IRA. Find your local equivalent of the S&P 500 index fund. Apply the same logic. And now, information without action is just entertainment. Here's exactly what to do in the next 24 hours. Step 1. Open the right account. For most viewers in the United States who are employed and have access to a 401k with employer match, log into your employer's benefits portal today and confirm that you are contributing enough to capture the full match. If you are not, increase your contribution by enough to capture the full match. This is step 1 because the employer match is the highest guaranteed return available to you. And every month, you are not capturing it as money that should be yours, that is not coming to you. If you do not have a 401k, or if you have already maximized your employer match, open a Roth IRA today. Fidelity, Vanguard, and Charles Schwab all offer Roth IRAs with no account minimums, no opening fees, and simple online account opening that takes approximately 10 to 15 minutes. You will need your social security number, a bank account number for linking, and a government-issued ID. That is the entire list of requirements. Go to fidelity.com, vanguard.com, or schwab.com. Click Open an Account. Select Roth IRA. Follow the prompts. This takes 15 minutes at most. Step 2. Set up automatic monthly transfer of $100. Inside your new account, find the option for automatic bank transfer or recurring contribution. Link your checking account. Set a recurring transfer of $100 on the same date each month, the first of the month or the day after your paycheck arrives, whichever makes more sense. Make this automatic so it requires no decision every month. The automatic transfer removes the psychological friction of having to choose to invest every 30 days. When the transfer is automatic, you adapt to living without that money. When it requires a manual decision, there will always be a month where something else feels more urgent. Step 3. Choose your fund. At Fidelity, search for FXAIX. This is the Fidelity 500 Index Fund, which tracks the S&P Key N0 transaction fee, expense ratio of 0.015%, essentially free. No minimum investment. Click Buy. Enter the amount. Confirm. Done. At Vanguard, search for VTI. This is the Vanguard Total Stock Market ETF. Same logic. Ultra low expense ratio. Broad diversification. Click Buy. At Schwab, search for SCHB or SWTSX. Same logic, same approach. If you are outside the United States and using a local broker, search for an index fund tracking your domestic market or a global index. Look for the lowest expense ratio available for that index. That is your fund. Step 4. Turn on dividend reinvestment. Inside your account settings, Find the option labeled DRIP Dividend Reinvestment Plan, or simply Dividend Reinvestment. Turn it on for your fund. This ensures that every dividend payment automatically purchases additional shares rather than sitting in cash. You will not notice this happening, but over 40 years, it will matter enormously. Step 5. Set a calendar reminder to increase your contribution by $10 every 6 months. In 6 months, increase your monthly contribution from $100 to $110. In another 6 months, $120. This gradual increase is nearly imperceptible in your budget, $10 a month, twice a year. But over a decade, it transforms your monthly contributions significantly and adds tens of thousands of dollars to your final balance. The reminder prevents you from forgetting. Set it now, today. Before you close this video, Step 6. Set a rule for yourself about market crashes. Write this down somewhere visible. It is one sentence. When the market goes down, I do not sell, I contribute. That is the rule. That is the entire investment philosophy that matters most during the moments when you will feel the most pressure to abandon it. Write it on a sticky note, if that is what it takes. Tape it to your monitor. The rule you set for yourself today before the next crash, when you are calm and the data is clear, is the rule that will protect your compounding timeline when fear is loudest. The maintenance plan. 10 minutes per year. Once a year, pick a date. Perhaps January 1st, perhaps your birthday, log into your investment account. Confirm that automatic contributions are running. Confirm that dividend reinvestment is on. Confirm that your fund selection still reflects your goals. Make no other changes. If the balance has changed, let it change. If the market is up, note it and move on. If the market is down, remind yourself of the rule you wrote down. Log out. Do not touch it for another year. Tools and apps for tracking your overall financial picture. Personal Capital, now called Empower, is a free tool that links all your accounts and shows your net worth in one view. Mint offers similar functionality for a simple investment-only tracker. Fidelity and Vanguard's own platforms are excellent. For education, the Our Personal Finance subreddit's wiki is one of the most comprehensive free resources on beginning investing available. The book A Simple Path to Wealth by J.L. Collins, a book written specifically as a letter from a father to his daughter about how to build wealth with index funds, is the clearest articulation of this investment philosophy I have encountered. For a more behavioral approach, The Psychology of Money by Morgan Housel addresses the human side of wealth building with unusual clarity and honesty. None of these are paid recommendations. All of them have genuinely been useful to me in understanding how this works. Now, the real answer to the question in the title is $100 a month enough? Enough for what? Enough to build somewhere between $300,000 and $600,000 from scratch. If you start reasonably young and stay consistent for 40 years, yes. The math says yes, with near certainty, given historical returns. Enough to retire in luxury without any other savings, income, or Social Security. That depends on your lifestyle, your retirement expenses, your timeline, and whether you supplement this over the years. $350,000 at a 4% withdrawal rate, a commonly referenced starting point for sustained withdrawal in retirement, produces approximately $14,000 per year of passive income that supplements other income meaningfully. It may not replace all income entirely, depending on your situation. Enough to change your financial trajectory starting today. Absolutely, unconditionally, with no asterisk. Here's the insight I want to leave you with, the one that contains everything we covered in the last 6 hours, compressed into its simplest form. The most expensive financial mistake is not a bad investment. The most expensive mistake is not starting. Not starting is a decision. It is made passively, without sitting down and saying, I decide not to invest. It is made by choosing something else, something that feels more urgent, or more rewarding in the moment, or more aligned with today's emotions. And it is made with compound consequences that grow larger every single year. It is made. The version of you 40 years from now is not abstract. That person exists on a trajectory that is being shaped right now by the decisions you are making this month. If you invest $100 this month and every month after it, that version of you has $349,000. If you spend that $100 this month and every month after it, that version of you has memories. Both are real choices. Only one of them compounds. Starting beats perfecting. This is the final truth of everything we covered. Not starting because you haven't found the perfect fund. Starting is better. Not starting because you're not sure about the right account. Starting is better. Not starting because the market might crash. Starting is better. Starting with a flawed strategy beats not starting with a perfect one, because compounding requires time above everything else, and waiting for perfect conditions is a way of trading time for comfort at a cost you will not see for 20 years. The person who starts imperfectly today, with too little money and not quite the right account in a fund that's second best, that person, in 20 years, will have more wealth than the person who spent those 20 years waiting to understand it more. Completely start today, imperfectly, with what you have. Drop a like if this helped you see the math clearly for the first time. And subscribe, because this is exactly the kind of long-form, honest, complete financial conversation we make here every time. Comment your starting age below. Not because I am collecting data, because writing it down, committing to a number, a date, a starting point, is itself a form of decision. And you just watched 6 hours of evidence for what happens when you actually make the decision. The $100 you invest this month is not the point. The 40 years it has to grow, that is the point. Start the clock.